Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Summit Therapeutics Inc. Annual Report. Summit Therapeutics Inc. offers a range of businesses and services that cater to patient care and medicinal therapies. At its core, the company focuses on developing and commercializing treatments that are friendly to patients, physicians, caregivers, and society as a whole. The company's lead development candidate is ivosimab, a bispecific antibody designed for immunotherapy through blockade of PD-1 with antiangiogenesis. This treatment is currently in phase III clinical trials for the treatment of non-small lung cancer. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The decline of a company's stock price is often a complex issue with multiple contributing factors. One possible reason for a decrease in stock value is poor financial performance, such as declining revenue or increased expenses that eat into profits. This can be due to various reasons, including market saturation, failure to innovate, or inability to adapt to changing consumer preferences. Another factor that can negatively impact a company's stock price is regulatory issues or legal troubles. If a company is found guilty of violating laws or regulations, it can lead to fines, penalties, and reputational damage, all of which can drive down the stock value. Additionally, changes in leadership or management can also affect a company's stock price. A sudden departure of key executives or a change in strategy can create uncertainty among investors, leading to a decline in stock value. Lastly, external market factors such as economic downturns, industry-wide trends, and global events can also impact a company's stock price. These factors are often beyond the control of individual companies, but can still have a significant impact on their financial performance and stock value. In summary, a decrease in stock price is often the result of a combination of internal and external factors that affect a company's financial performance, reputation, and market position. Summit Therapeutics Inc. market capitalization of $12 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Summit Therapeutics Inc. holds a significant advantage in their industry. Summit Therapeutics Inc. trades at a higher price-to-book ratio of 62.6 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 11% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be attributed to several key factors. Regulatory approval of new products, such as ivosimab, is a significant driver of revenue growth, page 5. Milestone payments and royalty payments tied to the achievement of regulatory approval also contribute to revenue growth, page 5. Additionally, orphan drug designation and exclusivity, patent term extension, and success in developing and commercializing products are all important drivers of revenue growth, pages 22-34. On the other hand, revenue decline can be attributed to factors such as unsuccessful regulatory approvals, limited marketing authorizations, post-marketing requirements, insufficient patent protection, and litigation relating to intellectual property, page 3. Dependence on key executives and personnel, social unrest, terrorism, natural disasters, health concerns, or pandemics/epidemics also pose a risk to revenue growth, page 3. Other drivers of revenue growth include coverage and reimbursement decisions by third-party payers, pricing negotiations with governments and regulatory bodies, and the adoption of cost-saving measures or changes in healthcare policies, pages 29. Conversely, dependence on additional financing may not be available on acceptable terms, which can also impact revenue growth, page 35. The net income of the company has experienced a significant decline over time. Initially, there was no information provided on net income in page 68, but by page 34, it had decreased to a substantial loss of $1,079.6 million. This trend continued with an even larger loss of $1,079,586, reported in page 104. The reasons behind this decline are multifaceted and can be attributed to various factors. The uncertainty surrounding third-party payer coverage and reimbursement rates has created significant challenges for the company, page 29. Additionally, increasing pressure from payers on prices charged, limitations on coverage and reimbursement rates, and the adoption of cost containment programs have all contributed to the decline in net income. Furthermore, conducting expensive pharmacoeconomic studies to demonstrate medical necessity and cost-effectiveness has also been a significant expense for the company, page 29. The variability in pricing and reimbursement schemes across countries and payers has added to the complexity and uncertainty faced by the company. Moreover, unforeseen costs associated with creating an independent sales and marketing organization have also had a negative impact on net income, page 41. The profit margins of the company are likely to be lower due to these challenges, particularly if third parties perform sales and marketing services, page 41. Overall, the decline in net income can be attributed to a combination of external factors such as regulatory pressures, reimbursement rates, and market variability, as well as internal factors such as high manufacturing costs for biologics and unforeseen expenses associated with creating an independent sales and marketing organization. The company's financial performance indicates a significant issue with its ability to generate positive operating cash flow. The data from the past 3 years shows a consistent trend of net cash being used in operating activities, rather than generated. In 2025, the company used $322,900,000 in operating cash flow, while in 2024 it was $142,100,000. This trend continued into 2023, where the company used $76,760. This lack of positive operating cash flow is a major concern for any business, as it can indicate underlying issues with profitability and efficiency. The data suggests that the company's expenses are exceeding its revenues, resulting in a net outflow of cash from operations. To address this issue, the company would need to implement cost-cutting measures or improve its revenue streams to generate positive operating cash flow. The company's debt level has undergone significant changes over the past few years. Initially, the total debt increased from $46,812 to $92,322 between two unspecified dates. However, by December 31, 2024 and 2025, the company had no debt at all. This drastic reduction in debt is a notable improvement for the company's financial health. The interest expenses have also seen a substantial decrease. In 2024, the company incurred an interest expense of $8,700,000, but by 2025, this figure dropped to zero. The trend continued into 2025, with no interest expense reported. This significant reduction in interest expenses is likely due to the elimination of debt and should have a positive impact on the company's bottom line. The management is expressing a cautious optimism about the company's future prospects. Despite incurring significant net losses and cash outflows from operating activities, the company remains committed to advancing its pipeline candidates through clinical development. This is evident from the completion of enrollment in the Harmony clinical trial, which demonstrated promising results for ivosymab in combination with chemotherapy. The management acknowledges that the company will need to raise additional capital to fund its ongoing operations and capital needs. However, they are exploring various options, including public or private equity or debt financings, to finance their operations until significant revenue can be generated from product sales. The submission of a BLA for ivosymab plus chemotherapy is also seen as a positive step towards securing regulatory approvals. Overall, the management's strategy appears to be focused on accelerating growth through strategic partnerships and advancing its pipeline candidates. While there are challenges ahead, the company remains committed to achieving its goals and generating significant revenue from product sales in the future. The company's financial policies have been scrutinized in recent reports. One notable aspect is the absence of dividend payments to shareholders. Despite opportunities to distribute profits, the company has chosen not to pay dividends, as indicated on pages 72, 107, and 124. On a contrasting note, the company has engaged in share buybacks. This strategic move allows the company to repurchase its own shares from the market, potentially boosting shareholder value. As stated on page 124, the company has indeed undertaken share buyback initiatives. There are valid concerns about inventory buildup or supply chain disruption. The Section 804 importation program and changes in Part D benefit redesign may lead to potential disruptions, page 30. Recent supply chain disruptions have already been experienced as an adverse economic condition, page 36. Several risk factors could exacerbate these issues, including weather conditions, natural disasters, contagious diseases, pandemics or epidemics, page 39. Additionally, delays due to import or export licenses and regulatory requirements may also occur, page 44. The impact of U.S.-China trade relations on supply chain operations and business is another concern, page 49. Furthermore, various potential causes of supply chain disruption have been identified, including natural disasters, social unrest, pandemics, and hospital closures, page 64. These factors highlight the complexity and vulnerability of global supply chains. That concludes the financial summary for Summit Therapeutics Inc. Feel free to comment below, and I will be happy to answer them when possible.